Print, email, Facebook, Twitter. More analysis. Budget 2018, income tax brackets and how the government's plan really works for something considered as certain as death. Confusion reigns when it comes to income tax. The government is selling its personal income tax plan by arguing that 94% of Australian taxpayers will pay no more than 32.5 cents in the dollar, compared to 63% if the current system is left unchanged. At the same time, analysis by various think tanks, experts and media outlets shows that the substantial majority of savings from the tax cuts will go to higher income earners. How do these numbers tally? It all comes down to tax brackets and marginal tax rates, essential features of a progressive tax system. In this context, progressive means that you pay a higher rate of tax as your income goes up. This is as opposed to a flat tax system, where everyone pays the same rate on all their income. Many people appear confused about this distinction, including former Treasurer Joe Hockey, who once said on Talkback Radio, "When Australians spend the first 6 months of the year working for the government, with tax rates nearly 50 cents in the dollar, it is a disincentive." This is a complete confusion of tax rates with the rate of tax paid. Few people on the top tax rate, even when it was almost 50 cents in the dollar, spent anywhere near 6 months working for the government. That's because that is their marginal tax rate. That is the tax rate they pay on every dollar they earn above the top income threshold. Currently $180,000. Even these very high income earners pay zero tax on the first $18,200 they earn due to the first tax bracket, the tax-free threshold. Adopting Mr. Hockey's analogy, someone who earns $200,000 annually actually spends the first 5 weeks of the year bludging off government services without paying any income tax. For personal income, Australia currently has 5 tax brackets. Taxable income tax on this income $0-$18,200 nil $18,200 and $1-$37,00019 C for each $1 over $18,200 $37,000 $3,572 plus 32.5 C for each $1 over $37,000 $87,001 $180,000 $19,822 plus 37 C for each $1 over $87,000 $180,001 and over $54,232 plus 45 C for each $1 over $180,000 not including 2% Medicare levy. Once you're clear on the difference between marginal tax rates and the rate of tax paid, it's much easier to understand how the Turnbull government's full 7-year tax plan favours high-income earners. The fundamental nature of this system is that a change in the threshold or rates at the bottom also benefits those in the middle and at the top. Phase 1 skewed towards middle and low earners as widely acknowledged. Phase 1 in July 2018 is directed at low-middle income earners, by introducing a 4-year low and middle income tax offset, LMITO, that affected taxpayers receive at the end of the year as part of their refund. Because this is a targeted refund, it doesn't feed through to high-income earners. The only bracket change is a $3,000 increase in the threshold for the 37% threshold to $90,000. The combination of the two means individuals earning $90,000 a year are the biggest beneficiaries in dollar terms, at $665 a year. But, even in Phase 1, higher income earners would benefit from this small change to the tune of $135 a year. That's because $3,000 of their income that was taxed at 37% will instead be taxed at 32.5%. Phase 2 mainly benefits upper middle and high earners in Phase 2. Starting from July 2022, the threshold for tipping into the 32.5% tax bracket will be lifted from $37,000 to $41,000 and the threshold for the 37% bracket will go from $90,000 to $120,000. This doesn't help low-income earners, with those earning up to $35,000 still only getting the $200 a year in benefits they started off with in July 2018. Likewise, Middle-income workers earning between $50,000 to $90,000, who lose the benefit of the MITO, will only get an extra $10 a year benefit from this phase. It is upper middle and high-income earners who will see the biggest rewards flow through, with everyone earning from $120,000 a year upwards keeping an extra $2,025 of their pay from the taxman. This highlights how a change in the lower tax thresholds benefit higher earners more. They receive tax cuts on their income between $37,000 to $41,000, as well as their income that falls into the $90,000 to $120,000 bracket. Phase 3 only benefits upper middle and high earners. Phase 3, which will kick in on July 1, 2024, is the centerpiece of the plan and the biggest change to the current system. It simply removes the 37% tax bracket from the system, creating one giant middle tax bracket of 32.5% for income between $41,000 to $200,000. That move doesn't give any additional tax relief to anyone earning $120,000 a year or less, but gives a steadily increasing tax break for everyone above that level until it tops out at the new top tax threshold of $200,000, where the 45% tax rate kicks in. The biggest beneficiary of this is anyone earning $200,000 a year or more, who gets 4.5 cents in the dollar tax relief on earnings between $120,001 to $180,000 and a 12.5 cents in the dollar tax cut on income between $180,001 to $200,000, adding $7,225 a year to their take-home income. Budget 2018. Who will win the tax cut wars? Choose 2 professions: surgeon, manurg, solicitor, programmer, electrician, truck driver, nurse, carpenter, social worker, cleaner, waiter, nurse, solicitor. 2019 saving $530, 50620223 saving $540, 1,1512025 saving $540, 1,151 median income $57,668 median income $100,581 calculation includes income tax, low income tax offset and low and middle income tax offset. Pros and cons of tax cut plan. Those are the facts, rather than the spin, of how the government's tax plan will change who pays what. But what will be the effects, the benefits and costs? Even amongst experts, this is really a matter of opinion. So here are a few expert views. Stephen Walters, Chief Economist, Australian Institute of Company Directors. Pros: at the margin, reducing the tax burden may help support household spending. Against a backdrop of record low wages growth, the system becomes simpler over time as the number of tax brackets shrinks from 5 to 4. Cons: full implementation takes too long. The final phase kicks in from 2024, at least 2 federal elections away. Abolishing the 37% tax bracket means the personal tax system becomes less progressive over time. Matt Grudnoff, Senior Economist, The Australia Institute. Pros: none given. Cons: the tax cuts will flow overwhelmingly to high-income earners, with more than 60% going to the top 20% and 40% going to the top 10% of taxpayers. High-income earners will get an oversized tax cut, completely out of proportion to their incomes. This tax cut will drastically reduce the progressive nature of our income tax system, which will increase inequality. The World Bank, IMF and prominent economists around the world have shown that rising inequality reduces economic growth. The reality of small government is fewer services. Flat tax advocates, like the Tea Party in the US, also oppose universal access to government services like health and education. It is unfortunate that this tax plan is over 7 years and not 4. This means that 3 years of this tax plan are outside the scrutiny of the budget and we are unable to probably assess its cost. It is also problematic that the most expensive parts of the tax cut that go overwhelmingly to high-income earners start on the 5th year, just 1 year outside the budget forward estimates. This greatly reduces the transparency of these tax cuts. Matthew O'Donnell, Senior Economist, Centre for Independent Studies. Pros: it is a fairer system in the sense that most taxpayers pay the same tax rate for each extra dollar they earn. Why should talented and hard-working individuals face increasing tax rates for providing their more valuable services to employers and consumers? It promotes economic growth as it provides the vast majority of middle-class Australians with the incentive to work more than previously. It reduces the impact of bracket creep. Increasing the size of the 32.5% tax threshold means that the effect of rising inflation on the average tax rates faced by taxpayers is lessened. Fewer thresholds mean that each year there are fewer taxpayers whose incomes rise into a higher income tax rate threshold, which increases their average tax rates. Cons. Announcing tax changes 4 and 6 years in the future is largely meaningless, even if they are put into legislation now. The main changes are not due to take effect until after 2 more federal elections. Just imagine what could happen between now and then. If implemented, the new income tax rates will be even more progressive as there is no change to the top tax rate. On the face of it, this seems like a good thing, but it will increase the already increasing disconnect between those that pay net tax and those that don't. The top 20% of income taxpayers currently pay about 61% of all income tax, up from 53.9% in 1996-97. Saul S. Lake, Independent Economist Prose. The government has attempted to concentrate the benefits of Step 1 of its plan on lower and middle income earners. Steps 2 and 3 of the government's plan will deliver a simpler personal income tax system, eliminating the 37.5% bracket, will substantially reduce the incentive for people earning taxable incomes of up to $200,000 to avoid tax by incorporating, an incentive which would otherwise be increased by the reduction in the company tax rate to 25%, or by using trust. Cons. The proposed changes do make the personal income tax system less progressive over a very broad range of taxable incomes. Australia will still have a relatively high top tax rate, cutting in at a relatively low threshold by international standards. Reducing the number of tax rates or brackets isn't really all that important. Professor Robert Brunig, Director, ANU Tax and Transfer Policy Institute. Pros. We should welcome the move to give money back to taxpayers who have seen income tax increase as a percentage of their income over the past few years. Cons. Nothing has been done to address the problems with GST or the complexity of the system, or to reduce the number of taxes. Nothing has been done to address the many expensive exemptions and exceptions in the system, which are actually a bigger threat to fairness than the marginal rate structure. Print email